Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed.
Hello. We're live, Rob. Bright and early out where you are. You're eating what I thought was a McDonald's sandwich. You said it was a little bit healthier than that. It was a Starbucks. So,
Do you think I would put McDonald's in this temple that I have here? Come on, Starbucks only.
are you trying to live forever, Rob?
I mean, we're all gonna live forever in the age of agentic economies, right? We're gonna have just breakthroughs. Like you and I are gonna be 150. We're gonna still be doing this podcast. People will still be listening to us.
Well, we could definitely get to 150. I don't know if people are going to still want to listen to our podcast. But yeah, there's some, I mean, I studied, I worked at this aging company called Elysium Health. And like, I saw some stuff in the timeline. David Sinclair, who's like this longevity researcher, a lot of the stuff that Brian Johnson references, he's making some pretty bold claims around like reversing aging and whatnot. So I feel like it's that time. We have to get into the state of the market. But beyond crypto, I think it's that time where like just anything can stick, because like the world's moving so fast. So this is the time where you can make the wildest predictions and people will listen probably, but more so than any other time, right?
I saw David Sinclair speak there. I went to this event back in October in Italy that was it was like for a big asset manager, and it was just like 60, 80 of like their biggest LPs. And then, they brought me and Paolo in to talk about crypto. And then there were some other people talking about other stuff. It was mostly a non-crypto event. And David Sinclair was one of the speakers. And like, it was like wild. Like he thinks that if you believe his vision of the future, that's going to be like utopia. We're going to be like the most like just healthiest, like best looking, we're going to live forever, like wild stuff. So, I think I came away from that though, that if I'm going to live forever, I really need to make more money. So these markets need to go better. So that's what I need.
Yeah, well, I mean, the question is, do you really want to live forever? Because I feel like there is some meaning in life if if there's finality to it. But also health span versus lifespan. Do you really want to live 150? Like, what is those last 30 years going to look like? Because what is crazy though is like
how well you feel. Yeah.
Yeah. Plus, like I mean, this is not a podcast about setting longevity, but what that means, but like the strain it has on infrastructure, on healthcare system, like that like the last mile spent, like the last few years of your life, it's like a disproportionate share in terms of medical spend, and it's crazy. It's like
It's like most of the medical spend, like vast majority.
it's most of it. Yeah. Anywho,
Well,
we're here to talk about
I mean,
crypto.
listen, I know you're a healthy guy, right? The first time I was at your apartment, one of the first things you showed me was your ice plunge. So,
Yes.
I know you're working towards that future. So,
Well, trying to be healthy. Let's talk about the markets. What's caught your attention? I mean, we'll give it no more than 5 minutes where we just spend a minute on the markets and then we'll move on because there's some interesting news happening this week.
well, Bitcoin's back up to 72, 73K today. So we've got a little bit of a rally. I think all the alts rallied a little bit. There's, I think some optimism that this Iran conflict will be short and not long. It's unclear, but over the weekend it was, I think, after the first day, the administration was out saying, listen, this will be pretty short. We killed a lot of the leadership. Going into the second and third day, I think you started to see some news that maybe that wasn't necessarily going to be true. I think the president himself said this will take at least 4 weeks on Sunday. And now, I think the market's kind of settling in and seems to be thinking that maybe this won't be a particularly long conflict, which is good. And then more broadly, we saw, I think, over $1 billion of ETF inflows in Bitcoin this week. Even with all of the volatility in the equity markets earlier this week, the Bitcoin kind of stayed range bound, which suggests to you that there's not a lot of structural sellers at the moment. And so I don't know, it feels like a very good setup for markets to do better in the medium term. I think I was talking to one of the big derivatives traders, and they were saying that if you were looking at the open interest and a lot of the options volume, like you could tell the market was like bearish, or at least they were predicting downside in the near term. but over the long term, for the rest of the year, the market was quite bullish. So, that's all positive. You saw the I think it was NYSE invested in OKX this morning, right? They want to provide more, spot crypto and spot crypto asset pricing, and they want to use OKX as their oracle. So that's like pretty interesting, right? So like clearly, like a lot of these big market participants continue to see the crypto as like important for what they want to do in the future. And then I think on the Iranian conflict stuff, right? You saw Hyperliquid and Polymarket have huge weekends in trading volume over the weekend, while the rest of the markets are down, right? And that talks to you again about like why these 24/7 permissionless markets are quite important for price discovery. So I don't know. I think it's all relatively positive at a time when people are, they've been quite negative for a period of weeks, if not months.
Yeah. Yeah. I was over the weekend. I think I tweeted about this, but that's where, so I was sitting down with a macro guy. We're talking about Iran, and it just happened. It was a topic around the conversation. It was a lunch. They're all speculating, right? They're all looking at their portfolios. They're all thinking about, okay, how do we position ourselves like come Monday? And they're just quiet, just immediately go to Hyperliquid and take a look at, and the market was up like 5%. And it's now sitting at like $84. That's when you actually truly now begin to understand,
This is
like,
oil you're talking
one,
about.
yeah, Brent oil. They have two markets, right? But nonetheless, I mean that's where like it makes you wonder, like it's gonna look very nonsensical in the next like 5 years, and you look back and you're like, why wasn't finance 24/7, like 365? And people would say, look, you can hedge it on the margin, like it's really not closed, but um and the criticisms maybe of Hyperliquid, it's like, hey, there's not that much volume here. So like if you're a large institution, you can't really hedge your book or whatnot. But you start seeing glimpses of like um how this infrastructure that has been built initially for just tokens and digital assets is now really going to be useful for other stuff. And this weekend, unfortunate as it was, it just like gave you a glimpse into the future. For me, like seeing the reaction of these people is I've only really felt that aha moment when I was describing stablecoins back in the day to someone. Um, and they really didn't understand DeFi. This was like 2020. DeFi wasn't even really a term, but you had some stablecoins, and I went back and told someone, look, go and use a stablecoin, and then come back to me. And they were raving about it. They're like, gosh, wire transfers suck. And look, I think I'm I'm very excited about this. I think like maybe I know you're close in Hyperliquid and Ostium and some other protocols that are trying to do this. Like, what is what is your like how you think about tokenized like commodities and equities? We've talked about them before in the pod, right? And some of these things haven't gotten as much traction as others. Um, but give us your view in terms of where are we in the build out of this? Like how are we ready to truly be 24/7 365, and or what are the things that you think still need to be built out to go in that direction fully?
Yeah, so we're definitely still not ready for it from a large infrastructure standpoint. But you know, I think I've talked about this a little bit in the past. But one of the major issues right now is simply like the accounting systems at the firms, right? So when it comes to perps are a little bit easier. These derivative products, because these are synthetic exposure to these things, right? And synthetic exposure, you don't necessarily. There's still accounting concerns. There's still like back office concerns, but the you're understanding like a derivative contract and being able to do like the appropriate accounting for that and collateral management for that is actually significantly easier than if you're doing spot in these commodities and in anything that's um, in inequities, etc. The structural issues for like the HIP 3 markets, they still exist very clearly. Like right now, they're trying to figure out, well, like how much risk can we actually bring on? I think the HIP 3 markets are capped at so you can't move, the price can't move more than 3x during like like on the 8-hour trailing price action. There's a and if it has like and that's if it's kind of like a native market. If it has a oracle to like a centralized exchange, it's something like I think it's like 1 to 1.5x that it can't move. There's, because of this kind of lagging Oracle price, there's a it's not necessarily like directly in line with like real price discovery, and liquidity is quite low. I think oil, there's a lot of people talking about like, okay, well, like you want to be able to trade oil on perps over the weekend, but there's actually Hyperliquid keeps putting open interest caps on it because they're worried about these kind of like really big movements when the market reopens. And so I think the open interest on oil got capped somewhere around 20 million bucks over the weekend. And there's a lot of this, all of this is really about risk, right? Is like how much risk can you take on at a time when you have a price that is supposed to be tracking something that is off chain and is not necessarily a native market, right? And so I think there's clearly a lot of work that continues to be done there. And while I believe Hyperliquid is a big part of that story, it's not a place where, call it the large institutions who trade Brent can actually go and hedge their risk, right? And I think this is gonna continue to be true as we have this dislocation between the really big, deep liquid markets that exist in off chain and then things like Hyperliquid. Now, I think those are going to get solved because I think more and more assets are going to get tokenized. More and more assets are going to move on these other markets. So whether it's at NYSE or CME or et cetera, are going to move towards on-chain rails and are going to move towards 24/7. And then as you have this becoming more normal that market makers and like broader market participants are interacting with these types of products 24/7 or 24/5, that makes it easier for also products like Hyperliquid, which are better experiences for a lot of traders, maybe not super sophisticated institutional, but for retail, to also be able to take on more risk and be able to allow for more risk over those periods of times. It's easier, I think, in the commodities markets and the FX markets because easier to dirty hedge, easier to move with the sun. Equities markets, I think, are probably the furthest away from having this really deep 24/7 liquidity, but maybe we'll continue to get a little bit of 24/5, which we have already with Citadel and others on Robinhood. Not quite 24/5, but close, who are willing to kind of warehouse some risk overnight.
Yeah. So what we're seeing here is just to put some stuff into perspective, you have hyperliquid markets. Gold, these are commodities. Gold by far has the highest open interest at 163 million, and pretty healthy volume because what you want to look at volume and open interest in that relationship. And then you have silver having way more volume actually than gold, less open interest. And then oil, to your point, there's two markets, one oil and then Brent oil has, I don't know, 8 million of open interest and 4 million of volume. And then, Brent oil has 9 million of volume and 3 million of open interest, 4 million of open interest. Like that's for any real commodities trader like Glencore, or he looks at that and says, this is embryonic at best. Like this is a proof of concept. To put, I was just kind of looking at to give folks some perspective, that's, the entire tokenized stock market is about 800 million to 1.6 billion. Like the NYSE does that in a single session, like before lunch. So
yeah,
it's,
I mean, listen, it's a great embryonic moment, right? Like it's exciting, and I don't want to, kind of underplay like what is happening here. I think it's incredible to see like so much interest as well. I mean, you saw Bloomberg and a bunch of others talk about it, but it is very clear that there is a lot of structural issues about how to increase risk parameters to be able to bring on people over the weekend, right? There's I was chatting about this with somebody else, but the there's all these working sessions that happen at the CFTC. So I sit at on the CFTC digital asset market subcommittee, and a lot of the conversation there over the last year had been around, okay, well, like how do we think about tokenized collateral relative to other types of wrappers, because tokenized collateral is essentially just wrappers, and can we use that in call it for prime brokers at maybe clearinghouses, and then if we do that, can we enable, call it 24/7 trading? Can we enable more like tokenized trading? What's the infrastructure that's needed? And a lot of these big trading shops were saying, listen, we think this is coming, but we're not set up yet, or we think we will be set up soon to be able to plug in our current systems to what is happening here. Those the market makers are furthest along, and I think they're there now, but they've been working on this for years. A lot of the takers, like, Balyasny, or, not to call them out specifically, but any of these types of guys that look like that, right? Like, you go and you ask them, okay, well, you want to do a trade on a weekend, and they'll say, well, like, we can't because, like, we keyed something in 20 years ago within our trade management system, and nobody knows Cobalt here anymore, and, like, we can't figure out how to, like, what type of tech that sits on top of that, so we don't know how to change it, right? And this actually exists at a lot of the hedge funds today. And so there's a lot of work that needs to continue to be done, and people are trying to modernize and digitize, especially in the age of AI. But it continues to be a work in progress.
Yeah. I mean, you made a pretty bold prediction on stablecoins. Is there an equivalent prediction here around volume? I think tokenized gold is the most advanced market, and it's like 0.002% of real like gold futures and whatnot. I think gold's at 3 billion. Like COMEX gold futures trade 50 to 100 billion a day. Physical gold market does 130 billion. Um, so what's your outlook, and what gets most traction first? Is it commodities? Is it stocks? And is it mostly retail, or what is it that really gets more adoption? And then second to that, like, what informs your investment thesis? Like, is it just hype? Is it ostium type, or is it just more something else?
Yeah. So I think over the weekend, Hyperliquid did like 5-6 billion on each day over the weekend in total. About 10 to 12% of that was in these, like, real world asset markets. That was actually, it had been higher percentage earlier in the month, when I think silver, it really ran up, and we had kind of that commodity top that existed. The That 5-6 billion for Hyperliquid was very high for a weekend. So normally the weekends are, call it like 1 to 2 billion, because the markets are a lot more dead, and then they go, 5 to 7 billion during the weekdays. Have been up to 10, and maybe more certain days where there's been a lot of interest. Where we've seen, the ability to increase these risk caps to get market makers and deep enough liquidity today, the easiest place to do that is in commodities right now, and FX, right? So those markets are open much longer, more globally, and you can do more hedging, much in different markets, and kind of move with the sun over like you can have broader coverage. Stocks is the toughest market right now, and so that's why we've seen, to your point on Hyperliquid, the open interest caps being the highest on the commodity side, gold specifically, because that's such a deep market, and FX. I think that'll continue to be true. These are still definitely very much like retail prosumer markets, and then maybe like, you know, what in crypto we might call institutional money, but in what outside of crypto we would not call, we would call prosumer money, right? And that's the people who are primarily trading these things right now. But listen, there's a lot of interest from a lot of the institutions. I have heard directly from big exchanges. They're connecting with Hyperliquid. They want to learn more about the infrastructure. They're thinking about how this works, and so that I believe that we will see, whether it is Hyperliquid or a current project out there, or whether it is, call it a new product that is, call it more form fit for a NYSE and a Nasdaq. We will see more and more of this type of trading happen on chain. I think spot is going to be tough in the near term. I think spot equity is the furthest away from getting adopted.
The Blockworks Digital Asset Summit is back in New York, March 24th through 26th. We'll have top speakers from leading asset managers, financial institutions, DeFi protocols, crypto companies, and policymakers, all under one roof. Think BlackRock, Coinbase, Robinhood, and more. Follow the link in today's show notes to buy tickets, and make sure to use code EMPIRE200 for $200 off at checkout.
Yeah. Speaking about the weekend, obviously another market that saw a lot of activity was Polymarket. Again, there was obviously the insider trading allegations come out again. Just to give people some context, like this isn't like one suspicious trade; it's pretty documented. Like during the Venezuela Maduro capture, like someone bet 32K, that turned into 400K, like hours before Trump announced it. On the Iran strikes, I think there was like 6 brand new wallets funded within 24 hours. of Operation Epic Fury. That netted them 1.2 million combined. There's been a couple of cases of like people getting going to jail, I think, or I think there was an IDF, like an Israeli Defense Force reserve member that got indicted in Israel for using classified strike plans to bet on Polymarket. That was back in June 2025 conflict. There was another account called Alpha Raccoon. He hit 22 out of 23 predictions correctly. He made like $1 million in 24 hours. There's now insider trading on Axiom that is going on. Like,
Well, actually, it's
clearly
a different story than the Polymarket.
different story, but I think
Cal
like
State, yeah.
they were like front running, right? Their customers basically. But on the Polymarket stuff, there's I think two schools of thought. One that says, look, it's insider trading and it's unfair. You shouldn't be doing it and clamp down on it. There's another more controversial stance that says, look, there is going to be insider trading on these markets, and that is a good thing. Like, you're getting and converging to the truth faster. Of course, people then have issues with that because it's like you're profiting, someone else is losing because you have an edge. But having a prediction market incentivizes these insiders to divulge this information, and so I guess one, more of a philosophical stance. I'd be curious, like, where do you stand in that divide?
Yeah, I mean, I'll put the Axiom stuff aside, 'cause the Axiom stuff was clearly just crime. And like those people should not have been doing what they were doing. They were accessing user data they should not have been accessing, and they were trading on people's like wallet information and front running, call it the customers. So that's obvious, like an obvious issue. On the prediction market side and what you've seen come out of Kalshi and Polymarket, um, it's nuanced, right? Because it really depends on the market. When you think about, these are CFTC regulated. So for the U.S. business, for Polymarket, and for the Kalshi U.S. business, these are CFTC regulated, right? And then there's the Polymarket international business, which is more the protocol and that you can access, permissionlessly. I mean, the same as Hyperliquid, right? Like the Hyperliquid had quote unquote insider trading allegations for the last year as well. That hasn't come to the forefront, as aggressively recently because there's been the conversation around the prediction markets, but the same exact conversation was happening when you saw big trades before announcements coming out of the administration on Hyperliquid in early last year. And that is there's two really main points around that. So one is like, okay, well, what does this mean for permissionless finance, right? What does it mean for Hyperliquid? What does it mean for any other and Polymarket, anybody else who has these call it, permissionless protocols that they can access? Do we believe that there is a need for, permissionless protocols to be able to police insider trading? And if we believe that's true, then how do we do that, right? And this is something that the Clarity Act is trying to solve for a little bit around, okay, well, what requirement do these permissionless protocols have in terms of KYC? And I think you and I would agree that if you're going to if these things are just law, or they're just code, right? And code is law, right? In some sense, and code is and that's a very, call it a spectrum and a very nuanced. How do we think through what requirement these have for KYC and for transaction monitoring and for et cetera? So that's a very tough conversation, number one. And I think that I'll put that to the side. Then there's the next question you asked me, which is, okay, well, what is insider trading on some of these markets? And insider trading is very clearly defined by the CFTC and the SEC, but these are commodity markets. And the CFTC, it really depends on what requirement do I have to an employer or to a centralized entity to not divulge information. But a lot of commodities markets and a lot of these really a lot of these derivative markets actually allow for some form of insider trading outside of within the CFTC, right? So it is if you're a somebody who buys and sells land, there is actually explicit ways of which you can trade on insider information. That's okay, right? This is true of commodity hedging. This is true of a lot of these different markets, right? And so but this is becoming a lot more, I think, opaque in a world where there is like a market for everything. And so what is that spectrum? I think very clearly there's the one side of the spectrum, which is, okay, well, I, am going to go trade on whether or not somebody is, whether or not Bad Bunny is going to perform at the halftime show of the Super Bowl. Very clearly, you have that's inside information that you have to a company, and inside and within that company, that information you're divulging to go and access and to make money, right? Also, the same thing with any of the equity linked markets, any of the earnings linked markets, et cetera. Right? This is very obvious. When it comes to anything around like rates or derivatives on commodities, like it's actually much more less clear that there is actual insider trading that based on current law, right? Or whether or not there would actually be any insiders who would not be allowed to trade that, right? We see it all the time with rates right now, and so that's a very murky side. And then there's this stuff that we have now around like, okay, well, the maybe people from the administration that are trading these things. I actually very clear. Like you asked, like what side I'm on moralistically. It got very clear to me that like that should not happen in the administration. I think that might actually require an act of Congress, though. Like I actually think under like the letter of the law today, they may be allowed to do that. They're not allowed to trade a. It actually depends
No,
a
I mean,
little bit.
no, well, this it's interesting, right? Because there was, I think it was Republican Richie Torres introduced the Public Integrity in Financial Prediction Markets Act in 2026, and specifically
Yeah,
would
to
prohibit.
get in front of this. Yeah, to
Yeah,
prohibit this.
exactly. And I think it
Exactly.
was in the speech. I think Trump called out specifically Nancy Pelosi. Um, and I think look, it's one of those things that uh, this would prohibit federal officials, political people, anyone basically in the government to trade on prediction markets tied to government policy. I think it's one of those things that, like, in my view, it's at a high level, these markets reveal truth, and that's a great thing. They are news and they're a signal. Um, and I think it's fairly clear in how the CFTC treats it, which is like if you're a government official, you have to KYC, and if you have KYC and you're putting money on the line on something that is confident, like this is national security information. And if you're betting whatever the amount, that obviously has implications for national security and divulging information to enemies of the state and potentially compromising a very complex coordinated operation. And
Yep.
obviously that is, I can understand very clearly. So I think it's going to be
I think there's one point that's like very important to make there though, which is the I think we can all agree that like that you're right, and we need to get in front of people in the administration trading on these protocols. But the nuance around how do we do KYC at a hyperliquid or at a on the Polymarket protocol itself, right? And what they're required to do has a lot of implications for DeFi, right?
correct.
And
If you well, you always identified a wallet. I mean, there's always an on ramp and off ramp event. It is at that, I've always felt it is at that particular checkpoint that you um, identify who controls that wallet. And we have the workflows. I mean, anyone that has interacted with Coinbase, for instance, like, Coinbase knows, um, Zach, does a wonderful, investigative, like
but
you're able to.
Coinbase isn't going to share your personal information with Hyperliquid.
I understand that, but you always, if you're subpoena, like you can always trace back who owns that wallet. So I'm saying, like, I don't think it's Hyperliquid or Polymarkets at the protocol level. They should be doing this. Now, if they also host an interface, then I guess in that stance, I don't know how I feel. Like if funds are already now, if funds are already on board in the financial system, you've KYC'd that person. If they already exist in DeFi, I don't think it's incumbent on like a Hyperliquid or a Polymarket to like verify. It's more like one thing I will say, like I think a lot of the criticisms, like the CFTC has like 1/8 the staff of the SEC to go after these things, which is a concern, right? I don't think there's been a single enforcement action in the US, even though there's been like, these allegations. Um, so it
I
is,
mean,
I think,
there is work being done. Like I think people like expect
there's
these
work being
things.
done, but like
Yeah.
these agencies are understaffed. What I'm saying is, I think, and this is something that I think it will serve us well as an industry to self-police. And if there is suspicion of some sort of nefarious activity or illegal activity, flag it. And I think the industry's been pretty good at that. Like when there's like hacks and there's stuff like that, people that are not cooperating get called out. publicly, and that I guess is, as an industry, I think we've gotten much better at that. But like if you're Polymarket and you register in your systems a spike in an activity like happened over the weekend, and the IP address or whatever, then and those funds were sent to an exchange to off ramp, well, notify the exchange. The exchange keeps a record of that. I think it was Kobe identified this individual within Coinbase that was trading ahead of exchange listings, obviously insider information, and exposed them because he looked on chain what was happening. And so,
But these are
eventually,
different points, right? Because like the person at Coinbase has they've signed an agreement with Coinbase that this is Coinbase information that they're not allowed. They are violating their agreement with Coinbase when they
yeah, I
do
mean,
that.
the same with a
Right?
government official that is in the Pentagon that has information of classified information is signed a very much a
Well,
way
it's actually a bit of a
tighter
new, but it's
NDA.
nuanced, right? Like the reason that Trump calls out Nancy Pelosi, right? And you see this all the time, is that every single one of these people in Congress right now, that when they sit on these committees, and then all of a sudden they hear in this committee that something's going to happen, and then they go and they trade their equities, they sell, they buy, they whatever. Like this has been a conversation for years. This is not a Polymarket or Hyperliquid specific point. This is a like, how do we expect our elected officials and our government officials to act? And this is why the Richie Torres put that
Yeah,
piece of
I think
legislation out there, right?
what I will say is that these are event contracts, right? And they're very binary, and so that's where I think it's just more. If Nancy Pelosi goes and full ports, defense and aerospace companies because she learned that there's a war coming, then I understand that, and I think that should be, you know, that's insider information. She shouldn't be allowed to trade. Um,
But we do
I think
allow it
it's
right now. That's the point.
which is allowed right now.
Yeah.
Everyone's following the Nancy tracker, and she's phenomenal. She's a better trader than she is a politician, and is outperforming pretty much everyone out there. But yeah, I think with these event things, it is. I think it's going to be nuanced. I don't think it's a clear
Yep.
cut thing. It's like it depends on the market, it depends on the individual. But if you or Rob have a set of drones and or you're tracking DoorDash activity of like Pizza Huts near the Pentagon and those things spike over the weekend and you go out and basically trade on every market that is tied to the US, invading a country, that's not insider trading. That's just,
Better
you have an
information.
edge. You have an
Yeah.
edge. You the same way that like hedge funds like have drones hovering over Walmart and Target and buy for that data. But if you're a politician or you're someone in the CIA or whatever and have access to classified information and you move the market, worst case that gives your enemy insight into what's
Yeah.
happening. Like that I think we can all agree is probably
Well,
like that not probably that should definitely be clamped down on.
one thing I did, I was in DC a couple of weeks ago. We had that episode while I was there, and I was talking to one of the I was talking to one member of Congress who was saying that they yeah, so every time a member of Congress does a trade or a swap, a derivative, et cetera, they have to go and they have to fill out a form that says that they did this. So this is part of the reason that we know that a lot of these members of politicians are great traders is because they actually go and they fill out these forms every time they do it, right? And this member of Congress was saying that he hasn't seen a single one of these forms filled out yet for a event contract, right? Which is obviously the point being is that some of these people are trading these as derivatives or swaps, and so like there's also an education thing happening here. I think like if you talk to Kalshi and Polymarket, they're very much in favor of this, like Richie Torres, uh, the piece of legislation that goes out there, and like would love to get it passed. But a lot of people, including at the exchanges at everywhere, have been open to trying to restrict government trading of any sort of security asset, et cetera. But the incentive is not there for the government, right? Like that has been the problem, right? Is how do we get our politicians to agree to that?
Yeah. I mean, this really goes to the heart of the issue that is there's a interagency turf war happening. The SEC wants to govern this. The CFTC said it wants to govern it. And it's kind of really in no man's land at the moment. I think it will serve us well to just have some sort of resolution. Where I think it's an interesting direction to kind of round out this chapter of discussion is what happens with equity linked event contracts. Right.
Yeah, because I mean, that's clearly there's no
Because the
doubt that if they're
NASDAQ,
trading these, yeah,
yeah, the NASDAQ just submitted, I think it was an application to have equity links contracts. In that case, if you have insider information on an equity and you think, and this is my opinion, if you're betting on a derivative of an equity and you have insider information, that should be treated no different than if you bought the underlying, in the same way that you can buy options and other derivative contracts to trade on insider information. I candidly don't care if it's under the CFTC or the SEC's purview. It is just, I think it's in that case is where we talk about being nuanced. Equity linked contracts should be
There's
governed
no nuance
differently
there.
than
Yeah,
geopolitical.
if you buy a call option versus a binary option, it's still you're buying an option on a security.
Correct. What I'm saying as it relates to prediction markets, though,
Yep.
I think that
No, I
is
agree with
still
you.
not clearly defined, but it will, in my opinion, should be treated no different than other contracts out there.
No, but I don't actually agree with that because under the CFTC guidance, like it's very clear, like what they're that see, Chairman Seelig has been very clear. Prediction markets go underneath the CFTC's regulatory framework. The CFTC has clear insider trading rules on those types of contracts or those types of markets. Like it's very clear what constitutes insider trading and what doesn't. So like that's very clear. There's a nuance on the protocol side about how you catch those people and like how we do KYC AML, but the whether or not this actually constitutes insider trading in those markets, that's not clear. That's not nuanced at all. Like that is very clear on those markets.
So just to clarify, because it was not clear for me coming in, if you're trading on equity linked event contracts on Polymarket or Kalshi and you have insider information, there's no ambiguity, even though the CFTC governs that.
Yeah, no ambiguity whatsoever.
No ambiguity. You will go to jail if you get
You
caught.
should. Yeah, correct. If you get caught.
You should, but the question is like,
If
there
you get
hasn't been
caught.
any. If you get caught, the key though is there hasn't been anyone that, not to say that there haven't been cases going
These
on.
these markets have been like they've had real liquidity for like 6 months, right?
Understand.
Yeah, I mean
And these cases take a while to. Again, we might be seeing, and I think there's some members that have said you should expect to see more enforcement going forward. This is these
yeah,
cases.
there will
take-
be. Absolutely. People expect these things to happen very, very quickly. Enforcement typically does not happen very quickly. It's much easier when you already have the robust framework at. I was at Goldman when I think there was an analyst there at the time who had given some insider information to a friend, and then that friend had told his dad, and then his dad had bought some call options about an M&A deal or whatever. That case still took 8 months to build because they had to go trace back that he had talked to his friend and friend had talked to his dad, despite the fact that like there's a very robust framework on seeing these links and these connections between people who trade these things.
Yeah, definitely. One of the common questions when I've described prediction markets to someone is the assassination piece. And it's like, hey, what happens if people are going to be more likely to do certain things? And you're like, well, not really dissimilar from insurance, right? Like there's always a risk, but like kidnapping insurance and some of these things, like people might be more induced, if you will, to go out and do certain things, but at the end of the day, these are illegal things, and so people should have an understanding of the repercussions. I
Well,
don't
and
think.
assassination markets don't exist on either Kalshi or Polymarket.
No, I understand that.
Yeah.
Not as, but it's like if you have like an event contract, is it making it that person that has agency over influencing that event be more likely to do that because they have a financial outcome on the back of that? And it's just I'm bringing it here because it's a common argument that gets brought up time and time again by skeptics of these like prediction markets. And I think the simple answer is like there's a whole insurance market that it hasn't stopped the insurance industry from having insuring against certain things. If you're insuring a boat, clearly someone might be incentivized to burn it and get a reward for it, but ultimately that
I mean,
has not stopped
ultimately, you could go long oil and have the same exact incentive, right? Because
Yeah.
Brent went up from $60 to $84, right?
Yeah.
Like it's the same exact incentive. So it's a little bit. It lacks, I think, like real forethought when people are like, "Oh yeah, well, like now this market exists on Polymarket, so like I'm definitely much more incentivized to do this thing than if I was just long Brent, right? Or if I was just short rates or whatever. It doesn't make a ton of sense in most cases when people talk about it. Now in these longer tail markets that have very little liquidity, when you're like, oh, like will Jason Kelsey propose to Taylor Swift, and then somebody like that's like of course like there's different incentives and stuff like that.
So maybe bring that up. Last point on prediction markets. If you are the best friend of the brother of Kelsey, and you know he's going to propose. You go out and full port the market, and what do you think of that? Illegal? Not illegal?
That's definitely not illegal. You're definitely allowed to do that, right? Under any current iteration of the law. Now, that might feel unfair, right? But any sort of event contract is a transfer of risk. So it's transfer of risk between you and I if we're on the other side of that. If you think that you have knowledge of whether or not Jason Kelsey will propose to Taylor Swift, and you're like, it's definitely not happening, and I know Jason, and he's definitely going to do it, or Travis Kelsey. I keep saying Jason, Travis Kelsey. This is how much I follow pop culture. I don't even know which Kelsey brother is doing this, but
sports betting has this issue, no? Like if you're, I guess my mental framework, moralistic framework is if you have influence over an event, in the same way that like there's been sports rigs, like sports betting, there's like a whole mafia, I think in Italy, that was like trading and bribing referees, and I do think that if you have undue influence over the outcome of the event, you shouldn't be trading on said event. Trade on everything else, just don't trade on that, because that creates unfair markets. And I think that that ultimately hurts the overall platform itself. I get that you're trying to surface the truth, but it creates an unfair market experience that I think in the long run, yeah, I know you're discussing that, hey, look, the world's going to know before that, they're going to get engaged, and that's a good thing. But I think it hurts the other side of the trade that does not have fair. It just feels very unfair, and in that instance, I think you shouldn't be trading in that particular market. As simple as that.
Listen, I moralistically, like people definitely have that perspective. There are a lot of markets where inside information is a key piece of how these markets are traded, but people having an edge versus another. The idea is that these are actually skill games, right? In the same way, like in poker, you can have more information than the next person, and it can be very unfair for that person, and you can go and win.
Yeah, but
right?
it's a random game. It's a game of probabilities. Like you can't like you don't have influence over the deck of cards. You can do certain things. You can count cards. You can have an edge by like seeing. I mean, we should ask Kasi, but like you can have an edge on how your opponent, like the other person at the table, like his mannerisms or like his ticks or whatever. But like for instance, a tech contract, Claude 5 released by March 15th, March 31st, or March 30th. Super low volume, less than 1 million aggregate. If you're working at Anthropic, and you have knowledge of this, you shouldn't be trading on this thing. Simple as that. If you're
but you're right about Anthropic, right? So like you're conflating 2 points, right? So like for Anthropic,
the distinction you're saying is you've worked at Anthropic, so you have an NDA, you can't divulge information, so you shouldn't be doing that. I get it. What is the difference if like I'm sure Taylor Swift has tight NDAs with her staff?
I mean, theoretically, if she has some sort of like obligation to, Taylor Swift or Taylor Swift Inc. or whatever, like there's something there. But like you asked about sports previously, right? Congress went and passed a law in the 60s to combat sports bribery and sports fixing, because before that, they saw sports as we saw a lot of fixing happening around betting, right?
You could
Because
say
there wasn't that
it
incentive.
destroyed the purity of the sport.
Right. And so Congress went and passed a law to do that, right? There are a lot of markets today where, like, for instance, like land markets or even like real estate sales, right? We very explicitly define the things that have to be told to the next buyer. And there are a lot of things that negatively affect the price of real estate that you do not have to tell the next person, right? And so when you go and trade a market that is, okay, well, the price of land in XYZ, there are a lot of people with inside information that are explicitly doing something that is legal that they know more than the next person, right? And so the question that you're asking is a moralistic one, but then there's also the question about the legal one, and it feels unfair to people, so they get upset about it, that they might be trading against, somebody who has more information. But the reality is all markets are about disparate information, right?
I mean, look, I think you're always interacting with imperfect information. And I get your point. If you're going to go buy land and you come to me and say, listen, man, I got a great parcel of land you should buy. I'm like, oh, shit. I trust Rob. I'm going to go fly to Ohio and I'm going to buy this great parcel of land. And it's at a discount. So, wow, it's a 20% discount. Anytime I see a discount, I'm saying, surely it can't be this good. Too good to be true. So I'm going to go and do due diligence. I'm going to go call an appraiser, and he's going to go in there and he's going to tell me, hey, look, I kind of get why Rob's going to get rid of this land. It's not because he wants to buy land in Miami. It's because, there's pests here, and there's a landfill not too far from here. It smells like shit. You come out and go see it. And, I get it. There's no perfect information in any market. All I'm saying is, if you're betting on a market that Elon Musk tweets X amount by March 3rd, and you're Elon Musk and you can influence that market, you shouldn't be doing that.
Let me ask you a question. Do you think that people should have the right to trade whatever market they want to trade? And I'm not talking about inside information, I'm just saying more broadly. And do you think people should take personal responsibility to if they are trading a market of which they do not have perfect information, right? Because this is the question that I have for you, right? Is that people think they have an edge. And a lot of what we've seen, by the way, a lot of the stuff that people think has been insider trading too have not been. So there was like the Nobel Peace Prize. There was a wallet that got created and traded. The right person winner of the Nobel Peace Prize like a few hours before it actually got announced. And everyone said, "Hey, that's insider trading." Turns out what actually was true is that you could actually just scrape the metadata of the website for Nobel and
Yeah,
like that.
the Nobel Peace Prize, the foundation released it, and
Yeah,
I
right.
get it.
And so there's a lot of stuff like that. But I think there's if you want to take the other side of a market relative to whether or not Travis Kelce will propose to Taylor Swift, like it strikes me that anybody should be able to take any bet they want, and there shouldn't be some like moralistic hand wringing around whether or not somebody else has better information than me about that market, right? Because that is just that is not
Again,
a market efficiency point, right? With equities, it is with these other but when it comes to these like long tail stuff,
let me ask you a question. So you're an investor in Polymarket, as I have exposure to it, to Parafine. Great. Okay. We want it to succeed. We want volume. You make money if Polymarket continues to get way more volume, right? If they they start profiting off of it. At the moment, it's not. Uh, what is a greater determinant of like the success of the platform and seeing volumes grow 100x? There's a reason why public markets have orders of magnitude more liquidity and volume than private markets, right? Because you have a set of standards and disclosures. They're not perfect by any stretch of the imagination. We all know them, and companies report quarterly, and they report very cookie cutter stuff. And anytime you want to do like more digging, but that, I think, a standard guidance around, you know, certain things that you have to disclose as a public company is the reason why these markets are way more liquid. All I'm saying is, I get it. You and I can strike a, a trade right now and say the Taylor Swift thing, and you could argue all day long, but all I'm saying is, I think if these markets are going to continue to thrive and get orders of magnitude more liquidity, I think it's if they make a proactive effort, whether the CFTC or the SEC governs them, around at least focusing on making these markets a bit more fair.
yeah.
And
But
and
listen,
and, and if I don't think the answer is like take down market like certain contracts. I think just if they're going to exist, fine. But I will say maybe the answer is on the KYC side is before it could be something as simple as before you click a trade, it's like if you have privileged information, if you're Elon and you can influence this market, um, we strongly advise against doing that because it was in breach of our terms of service. And if we figure this out, you will no longer be able to trade on this platform. It's not perfect, but at least it gives a perception of, hey, we're trying to create fairness in these markets, and maybe that's what in the long run leads to the Elon market not having 11 million of volume, but a rather 100 million of volume.
yeah. Well, I think where this gets even more murkier is like the mention markets, right? So there's been a lot of conversation about these mention markets, which is
Yeah.
people,
You got Brian Armstrong in the earnings call. Like,
yeah. So those it becomes a bit more murky there because it's like, okay, well, I can take a bet that like, or someone near me can take a bet that I will say XYZ thing during an earnings call or during, a speech or whatever, and my speechwriter can tell me to say this thing, right? And so there's a question there. I think the one thing that I will agree with you on. So maybe saying, okay, well, we'll try to self-police the platform if you have privileged information. Maybe that works. I think there's a long tail of stuff that is not illegal today that exists with insider information and is meant to exist with insider information. I don't think that needs to change, maybe, but there is this long tail of kind of gray area that like we have to figure out um, how to make people feel like it's fair, right? And because to your point, it increases liquidity, it makes people happier. You want people coming back to the platform. I mean,
I mean,
and,
you
and
focus
if
on
people are just
customer
losers, they're not
retention,
going to do it.
customer
Yeah.
retention and repeat. Like the other thing is like what you just said, I will push back on because as an industry, we always say, look, this is a new technology. We should craft rules and regulations that meet the technology where it is and not try like we should like really rethink the how we test or really rethink some of these rules and regulations that were just not meant for this technology. And at the same time, I'm hearing you say, look, these things they're insider markets in real estate and these other industries and we should just look at that as precedent and not do anything about it. And all I'm saying here is no, we definitely should. Absolutely we should because
But
these
these
are
aren't new markets. This is what Polymarket is a new form
it's
factor
it's a
for
new
how to
form
deliver
factor to express your
deliver a
view
derivative. Yeah.
with 24/7 digital markets. It is attracting a lot of liquidity. If I were on their team, I would say just put some sort of terms of service, just put some sort of notice there. It might be subtle, but in the long term, I think it inspires more confidence in these markets. And in the long term, even in the near term, I think it inspires more confidence in people to come to the platform and place bets. And I think that is it might be as simple as that. I wouldn't wait for the CFTC. I wouldn't wait for the SEC to give you clear guidance. I would just very simply say, if you have influence over this market, you shouldn't be trading on this market because it's in breach of our terms of service. And I think if you're like, take a fucking position. I would be, in fact, I would build a prediction. If someone is building a prediction market right now that wants to take this position, I would love to talk to you because I will fund it.
If I mean, it depends a lot of nuance. Um, Both Kalshi and Polymarket have been very clear that they want to weed out insider trading. They're both working on weeding out insider trading as insider trading is defined by the CFTC. There's a bunch of nuance around some of these long tail markets. We've spent a bunch of time talking about markets that have no liquidity. The markets that do have a lot of liquidity are much more clear as a rule, and people are working through that. So I think it, maybe we should just leave it at that. That Santi is a man of the people, and
No,
the
I'm not a man of the people. I'm just saying, like, let's create fair markets because that's what inspires more confidence people to come in and trade. And you want these platforms to have way more volume. So I think it's the right business decision. So I just as a point of, as of now, I put in the machine Polymarket's terms of service, and it said, does the TOS prohibit insider trading? Short answer, no, not explicitly. So just because the regulatory picture is murky doesn't mean that you can't take a more proactive business decision because it is the right thing to do for the business. Is all I'm saying. But end of conversation. What else? We've been at it for 52 minutes talking about two things.
a lot of Polymarket. Yeah.
A lot of Polymarket, a lot of markets. What else? I mean, you mentioned the OKX round.
Yeah.
You guys are not investors in OKX, right? You're investors in other stuff like Bybit.
No, we're investors in Bybit. Yeah.
What do you think of that? Fair? Good?
Listen, it's great for the whole industry, right? So OKX, they've obviously they were kind of the OG, right? I think OKX was founded in 2014, maybe it was a little bit before that. They were kind of the first big, Asian exchange, grew really quickly, lost a little bit of ground, in the last, 6-7 years to Binance and to Bybit. But, I know they've been focused for a lot of the last couple of years on trying to enter the US and find ways to do that. And this is obviously a way to do that. And then they can also, on the other side, offer, NIC linked, tokenized equities. And so good for the industry, like very exciting to see, Jeff Sprecher and the ICE guys, like he's just been incredibly forward thinking in terms of how he wants to move his business forward, first with the Polymarket investment and now with this investment. I have to give him all the credit in the world for really being willing to put, his neck out there on how he thinks through the future of markets. And so super bullish for everybody involved. Congrats to the OKX guys. And, excited to see, this industry flourish even at a time when people seem bearish on prices.
I know on the point of bearish prices, like what's a house for you internally at Dragonfly? Like, are you guys deploying faster now that you have this fund? You have some liquid positions, right, in residual funds, right?
So we
Really?
don't invest in new like secondary markets. We don't invest in liquid, but obviously, like we do an investment in the seed of Athena. We end up owning a lot of the token in the future, right? Uh, the we're not like actively trading any markets or anything like that, though.
Has that always been the case? Like, you guys are not necessarily, because you had before, like, some sort of credit fund, like,
We had a
more
hedge
like liquid.
fund
You had a hedge
that
fund that
yeah
went to
in
credit?
21 and 22, and then we spun it out in 23 that to Brevin Howard. Yeah.
Yeah, yeah. So you're typically not like you're managing risk in the book. Like if you have a liquid vesting position and you're way up and your fund's coming out to its life, like you have to do something with that, right? But you're
Yeah, we
typically not
manage
like
risk is the right way to think about it, but we're not
managing.
trading.
Yeah, yeah. What else?
I mean, there's the Paradigm and Andreessen fund news
Yeah,
that's out there.
big
Obviously,
funds.
yeah, big targets, which is great. So we announced our fund, obviously, whatever that was a couple of weeks ago, which was the biggest one in a while. And then Paradigm came out, I think, pretty quickly after, said they're trying to raise 1.5 billion. And what actually happens is these guys they have to do filings around it, especially when they're going to be one of two things happens, which is how the reporters find out about it. Either one is like they're sending out their deck to some LPs and people are leaking it, or two, once they do first close, they actually have to go and do a filing, and then you have all these reporters are like scraping Edgar. I think in both these cases, what these are just leaks, so they haven't. Neither of these
Hmm.
funds have done first close yet, but
It's when it's above 150, you have to disclose it, right?
yeah, there's a little bit of nuance there and exemptions, et cetera. But basically, when you're above, and so for Paradigm, they went out to raise 1.5. They had raised 850 a couple of years ago, maybe a year and a half, 2 years ago, and so obviously this is below the 2021 amount that they raised because they'd raised 2.5 then, but above the 850 that they had raised in 24, and so we'll see how that goes for them. I think, Matt's obviously got an incredible track record and, brand name, and they're talking about, widening their aperture to do AI and robotics. That's interesting because they had talked about doing that in 24 and the market got really mad at them for it. And now it feels like, you know, table stakes, right? Which is that, okay, well, if they want to do that, if you're going to put, $1.5 billion to work, it might make sense. They've obviously been very focused on tempo and, I think haven't been quite as active investors in other projects. So I'm not surprised to see that. And so I'll be interested to see how they think about, evolving the fund over time. And then Andreessen's just a different story because Andreessen actually buys a lot of liquids. So this, $2 billion fund is below I think it was 4 billion that they had raised in
Hmm.
21.
Yeah, it was
And
4 billion, and then they had some turnover and stuff like that. Now they're raising
yeah,
two.
they've had some turnover, and so there's now only 5 or 6 investors there, but they do a lot of they're just they'll put money structurally long into tokens, and so it's I guess it's easier to deploy. But I'll be interested to see. I'm sure Intrusion will be fine because of
Yeah.
the just the
No, but it's
aperture of
a
the business, but I'll
It
be interested to see
it
how it
helps the
works.
industry. I mean, it's a good signal to understand how much appetite there is from traditional allocators to deploy. There's a what is the right size for I appreciate the strategy of venture liquid, and A16Z does liquid as well, but like there's laws of gravity that as soon as returns degrade with fund size, and also vintages also matter here. Like if you're the early private equity vintages of the 80s, absolutely killed it. Typically, first vintages tend to outperform smaller managers, you know, at the right size, do quite well. These are all kind of generalizations, but by and large, the data is pretty compelling. Like the bigger the fund size, um, the returns degrade. And there's a lot of other confounding, like there's a lot of data that goes into this, but like macro environment factors in, right? Like if you're a crypto fund, like the last 5 years have been pretty tough. Like, but generally curious, like this data for anyone like looking at the screen is like vintage compression, and also talks about scale, and how what that does to returns. We've talked about benchmark being probably a clear outlier here. It's not in this graphic, but they've kept fund size pretty consistent around the 300 number plus 100 million of GP commit, which is very different than pretty much every other venture fund out there. Like, walk me through the thought process around raising what you guys raised, and how do you right size that for the opportunity setting in crypto? Like I've heard you say, look, fintech, the lines are kind of converging. We're going to want to have like, we probably had the opportunity to maybe lead rounds or step up in a bigger way, but we couldn't. So we're going to raise like Rains of the world and Polymarkets of the world. Like clearly you could have deployed way more capital in there and you bumped into your concentration risk. But like maybe Paradigm could be a good admission of the opportunity set where they're saying, we're going to raise 1.5 billion. It's smaller than their last fund. And we're going to go and invest in these other areas. And that's why we need, but if it were just crypto, maybe it would have been like a fraction of that.
Yeah, it's interesting. So if you look at the last vintage, right? So we can look forward and we can look backward. If you look at the last vintage, there are funds, including ours, in the 300 to 650 range that performed, top decile, and as well as and better than the vast majority of the smaller funds, right? There's maybe one or two of us, I think, that did that. And it was clear that, if you had picked right, that there was an ability at that size to still continue to perform really well. And obviously those funds are still, 4 or 5 years in, and so there's still obviously a lot of a long way to go, and prices could keep them down or they could go up. So it's unclear exactly where those funds will end up, but it looks like you could have been that size in that vintage and and still had great returns. Now, obviously, if you hit the right thing really out of the ballpark, a sub $50 million fund, and enough ownership, that is, you were going to be able to crush it. When you got into the bigger sizes, I think a couple of those funds have done okay, but there was, I think at the $1 billion plus, it's been much harder for people. But I do think the opportunity set is getting bigger. Like it's both getting bigger and narrower, right? Which means that there's far less to put money in, or far less like just verticals and far less like things and ideas to put money in today. But there's far more of those things to put more money into, right? So you're seeing the Rains of the Polymarkets and the Kalshis of the world get to scale, right?
Mhm.
You're seeing a lot, Mesh, another one that we just did. You're seeing a lot of businesses get quite a bit bigger because you're seeing Kraken and OKX, these guys, because you're seeing them gain scale and users and liquidity and volumes in a way that they haven't in prior cycles, right? And so I think when you look out into the future, people are saying, okay, well, we see that especially with AI, and this is what happened in traditional venture, there's more and more business that is growing very quickly, and there are more and more businesses that will be just started because of AI. So we'll have like more ability to put money to work in these things, and they're growing
Mhm.
much more quickly. And so I don't know if the $2 billion is able to be put to work in crypto and be able to have good returns. I also, and this, and I know this, like certain asset managers have different strategies, right? Which is that, if you can return a 1.5 or 1.7x fund reliably, but you can raise a big fund and have, a lot of management fees, you'd much rather do that than have a, swing for a 2.5 or 3x fund and have less money, right? And so it's a push pull for everybody.
I want to two things before we wrap. This is I mean, Thrive's been doing a lot of chatter on the timeline, of course, because there was a great podcast. I think it was Invest by the Best. I mean, this is just going back to historically like performance here, like the first fund's delivering a strong return, and a lot of these like need a harvest and stuff, and companies are staying public, like private longer. Like I just heard rumors around like Andrew raising a round at 60 billion, Thrive's leading it with a16z. That I'm sure will be a great investment for them. But yeah, it was just interesting. Like, how do you guys think about like DPI? When to like, especially for tokens that vest and are liquid? Like, you have a 10-year fund, you have an investment that maybe launch a token in 2 years, and you're vesting over the subsequent 2 years. Like, at what point do you start DPIing, focusing on the next fund versus holding the position and compounding?
Yeah. So I want to comment one thing on this slide that you're showing right now, which like somebody put this box around these 5, 6x funds and put that's all, which is like the most ridiculous comment. Like it is so hard to return 6x a fund. Like that is it is insane.
Well, the point was, and I'll say like they don't outperform the Nasdaq during that same time frame. And it was like, I'll pull up the math, but
Is that true? 2014 to now that that IRR is lower than Nasdaq.
that was their point. I mean, I'll take it at face value, but they said, look, even if you factor in for capital calls over that period, you're not really outperforming the benchmark here, which is just being liquid and being exposed to the Nasdaq. Which I ultimately like that is always the benchmark, right?
Yeah, I mean, the other thing that's true, of course, right, is that this idea that we like compare everything to the S&P or the Nasdaq is like obviously not how sophisticated investors think about things, right? They want diversified exposure to different things, right? Which is that in maybe the Nasdaq, which is basically all Nvidia for the last couple of years. Okay, well that performs one way, but Thrive is very heavily invested in fintech, and that might perform differently, right? And it depends on when you harvest, when you get liquidity, all this different stuff. And so like people care a lot about total return, they care a lot about diversified risk, and so like whenever you see like commentary on Twitter that's like, hey, like oh this is the same as the S&P, like those people aren't actually real investors, right? Because like that's not how anybody who sits in those seats actually thinks about capital allocation, right?
I will
Uh,
say, like, in fairness, like, yes, I get your point that, like, you have to build up like, correlation risk is something that gets lost in some of this commentary because that's why I like the case for investing in hedge funds. Even though they're not outperforming the S&P or the Nasdaq, they serve a purpose in your portfolio. It's like buying insurance, right? Because they may underperform for many years, and then when there's a two standard or two sigma event or like a very fat tail event, they really show up, and they show up in a very meaningful way. In the same way that you pay insurance, because for flood insurance, and it might take 10 years, but when that hurricane hits, your house is insured. So that's I get your point, but I think there is some truth into like you're saying the right thing, which is allocators don't think this way. They have 20% of their book that needs to get allocated to alternatives. Go find me the best managers. By and large, Thrive is a good manager. Within crypto, there's a very handful, very small set of now funds, you guys included, Parify, a16z, Paradigm. There's not that many funds out there, right? So you want to get exposure to the best managers because, by the way, having access to maybe Thrive gives you insight into how you invest in the public markets, right?
No, for sure. There's
And
a lot of
yeah.
reasons to do these investments, and I think I was talking to I was at like a sort of an institutional allocators event last week, and one of the guys on the panel that I was on, who was a kind of a large multifamily office, he was saying that well, a lot of people talk about how like venture funds and staying private for longer have been sort of like volatility washing, right? Which is that like the volatility
Mm.
is still happening at these companies, but the marks aren't as volatile on at least on the equity side. In crypto tokens, it's different, and that's a lot of people talk about that as if it's a bad thing. And for us as managers, we actually see that as a good thing. Like we actually want that volatility washing, right? Like we are excited about that because it allows us to think about our risk differently and allows us to have different information, right? And so it's the allocators actually think about these things much more differently than whatever the conversation is on Twitter. I will say to your original question to me, which is like, oh, how do we think about harvesting DPI? Um, my LPs and all LPs, they do care about IRR, but at the end of the day, the main incentive for all of us is to return the best money, the best MOIC, right? The best multiple of what people invested, right? And so the way we think about it is we have two clients. We have LPs and we have our founders, right? And to do right by both of them, we are going to be long-term investors that are going to have a thesis. We're going to be put our money behind that thesis. We're going to support our companies that as they try to build out that thesis. And when that thesis is no longer true, that's when we think about harvesting, right? And that's the way most managers think about it into our long-term venture investors. And that is part of the reason that DPI does take a while for a lot of these guys, even at a time where a third of exits are secondary markets now, and it's much easier than ever to sell a secondary position.
Yeah, is that still true in crypto, or you're talking about traditional markets to do secondaries? Because I have heard a lot of DPI comes from secondaries, but I think for crypto funds, it's not as true for venture funds, like non-crypto
Yeah,
funds.
it's probably not as true because it's a little bit different because like you have, then you have liquid tokens that you can theoretically sell in the open market versus like equity secondaries. But that's a stat I saw from Carta, I think. So it's like
Yeah,
traditional
yeah, yeah.
venture
Yeah,
investors.
certainly. Like there's if you have even like some crypto stuff like Polymarket, ton of demand. Call Sheet, probably ton of demand.
Yep.
Some of your tokens, not so much. But um, all right. Well, we've been at it for over an hour. I do want to get the content of the week. Just before we go there, sir, just sir, I'm really looking forward to our dinner. We have here Western Union, Sol. Since we placed that bet, Sol is down a barbaric 52%. Western Union cruising by plus 6%. What do we make of this, Rob? Is it going to correct? Is it over? Like, is Sol and all the L1s overly punished, or what's going to happen here?
Do you think the crypto market's going to come back or not?
I think I do. Look, crypto demand is up and to the right. Stablecoins, certain KPIs are up and to the right. I don't think many tokens are investable. And we've talked about it at length here. So this is, I think, the part of me thinks that a lot of these tokens have been overly corrected, overly punished. Even like certain stuff is starting to get interesting at the application layer. We did a great recording with Tushar and from Multicoin and Pranav from VanEck, and we were talking about like the dashboard, like Blockworks around like revenue of these protocols, and what seems to be the pair trade of the cycle is go long applications that are cranking out revenue, and I would characterize Hyperliquid as that, even though it's technically kind of an L1, but it's there's a lot of interesting like Aave, Camino, even Pump. If you feel that meme coins are not going to go away, like they're actually pretty interesting. They don't have a lot of liquidity, and it may but it's ultimately I'm a view that eventually if you're producing cash flow, if you're producing genuine activity, and it's either in buybacks or something like that, that should be reflected in the price at some point. Just be patient enough. Coming up in DAS, Yano's not here. Yano would be proud for me plugging DAS. The guy from Western Union, I think the CEO of Western Union is going to be in DAS. I'm actually pretty excited to go have a conversation, see what they've been up to. And what their next earnings, like what that actually shows. And Klarna is in this bucket too. Stripe is private, but in this bucket as well. Yeah, I'm just really excited about what these companies are doing and how it shows up in the P&L. Like not the narrative, not the Long Island iced tea pilot narrative. It's like, are you showing margin improvement with stablecoins? And I think that to me is more investable than a token at the moment.
Yep. Yeah, I think a bet's never over till it's over. I made a bet with Pranav from VanEck last May on something else.
I'm concerned about counterparty risk, Rob. Are you going to be good for this or not? You're making bets left and right here.
Well, so this was last May, and I was right on this bet we made a year-long bet, 12-month bet. And I was right for 7 months, and now I'm going to lose over what's happened this year, right? And so like it feels like you're gloating a little bit early. Is my own point.
I'm gloating. I'm just simply looking at the chart. I'm like, Western Union not losing me money. But was this a year-long bet? I forget. We got to go back to record.
Yeah, we talked about it for I think it was a year. Yeah.
November. Okay, it was a dinner, right? You wanted to put 10K or so, but I said, look, I'm gonna be a friend. I don't want you to lose that much money. I want it was the dinner, right? And Yano, I think Yano's in for a bottle of wine or something like that.
Yeah, I think I asked to bet your Patek, which is which I'm glad we didn't go that far yet. So, but
fair enough.
We'll see.
All right, man. Well, this is a great discussion. Content of the week.
I've been a little light on content because I've been doing a lot of travel this week, but I did watch the Industry season finale. Still the best show on TV right now. So if you haven't been watching Industry, season finale was great on Sunday. So go back and watch it.
HBO or
HBO. Yeah.
Is it the Billions like or Dynasty like or what's it about?
So Industry's it's evolved a lot over the 4 seasons that they've been on. But it started off basically as kind of following a couple of analysts and what happens at an investment bank in London. That's evolved now to like now somebody has a hedge fund and kind of a family office, and now they're like this season was all about a short only. One of the main characters is kind of running a short only strategy at a fund and trying to uncover fraud at a
basically
kind of a tech high flying tech company.
Is this Muddy Waters or what's the name of that shop that goes on Seeking Alpha?
Yeah, like stuff like that, and it's and the person or the company that at risk like looks a lot like it looks a lot kind of like the the World Pay, or was it Worldline? Yeah, it was Worldline fraud that happened a few years ago. Yeah, around what they were doing. Yeah, exactly. So, there's some parallels to that. Kind of an interesting season. And so go watch industry. Definitely the one show that I've been watching religiously this the last few months. So
Nice. That's great. I haven't finished it, but Cheeky Pint, the podcast by I think one of the Collison brothers from Stripe. Um, I don't know if it just came out or not, but it's an interview with Elon talking about space, colonization, energy. Pretty interesting. I mean, Elon is just one of those guys that is really, you know, I think a common theme that we're starting to hear now is like a lot of the software companies are going to come to a realization that hardware realization, like how hard it is to like, um, build compute and energy, like that situational awareness papers circling around now because that fund, is seems to be up dramatically. Right, started with like 200 million, now like up 5 billion, raised some money, but like vast outperformance. But yeah, no, it's I'm halfway through it. Seems pretty interesting. I mean, I'm nowhere near as like physics was my worst subject in school. Not my worst, but like, a lot of this stuff is over my head, but it is something that I want to get just I'm reading up on more like this energy and you know the flywheel that we've seen, more energy, more intelligence, like compute intelligence flywheel, right? And the biggest bottleneck is just energy.
yeah, I will tell you, being in SF this week, the fever pitch of like agents and what's happening in AI, you definitely feel it more than you feel it in New York, which I think is both good and bad because there's a little bit of like collective delusion that happens when I think you're here as well. So
For sure. How AI forward are you? Do you feel very far behind in your how you're using it, or do you feel like you hold your ground and you're like properly utilizing it? And I appreciate some of these tools you just can't use, right, because of like regulatory or
yeah,
compliance
so,
reasons. But
so definitely a little bit behind. I would say there's also things that like a lot of the things that people talk about doing when talk to people around the bay, like I would just never do. It wouldn't make any sense, right? Like I'm not giving a open claw bot like access to my email right now. Like that makes absolutely no sense for me. And as the amount of risk people are taking on, but if you're someone that's like a bit of a hacker and you can try to put guardrails around these things, like it's interesting. It's something we've been talking about a lot internally at the fund too, which is like, okay, well, how do we build out the right tooling to make sure that people are as efficient as possible? I think a lot of VC funds are doing this right now, which is um, what is the right intersection of like, okay, let's not put ourselves at a lot of risk. Let's not, you know, uh, put our both regulatory and from just like our systems, and especially as a crypto fund too, right? There's,
yeah, there's added
it's not
layers.
there's added layers of risk there, right? And so, but also, how do we make sure that the team is as efficient as possible? Uh, I was talking to I was in Menlo Park yesterday, and I was going on a walk with a really well known person who runs a very large company in our space, and also has been a bit of an active investor. And this person was saying that they spun up a bunch of agents who they gave 50 grand to, and then kind of put these guardrails around them and are letting them do like a bunch of market making on like centralized exchanges. And there's like some cool hacking and stuff that happens around there. But
Yeah.
and I think we can see the future, but I do think it's very hard right now
Mm.
if you to take as much risk in positions like ours as
Yeah.
you're hearing a lot of the conversation and that people are doing. So,
Yeah. Read right problematic. Read less problematic.
yep.
Um,
But
no,
right is where a lot of the kind of
yeah,
magic
that's
comes
where a
in.
lot of
So,
the but I've certainly, yeah, topic for a separate conversation. But I do spend most of my time thinking about what is AI resistant, to what degree. And I think for primary research, for just getting up to speed on certain information, like that is like far and away like even sourcing, right? Just identifying like a specific sector that I like, give me all the companies within in the northeast that are like factoring businesses, like, and give me all the contact information. I'm not going as far of like emailing them and writing personal, like I want to have some supervision. um where I'm leveling up more is on the skills stuff, because having memory and really focusing more on architecture and then the skills versus just going and prompting, I think that's where like Claude is really good at. Like if you spend a little bit of time up front, like designing the prompt and having like certain checkpoints, you get way more output. But I mean, still crazy. By the time we're recording, like less than 5% of the population has downloaded these things, and most of them are using them for like regular chat GPT. They have no understanding of like co-work and more advanced workflows. And yeah, just probably a reflection that technology still as great as it is, right, it still takes like years and years and years to permeate into the mainstream. So
Yeah, no, I agree. And I think there's a lot more conversation right now than there is actual like things to do in some of these areas that people are very excited about. But the world is moving quicker than ever before. And so, I think a lot of that conversation is around the fact that maybe things will just be drastically different in 3 or 6 months. And you kind of see it in the markets, right? The markets are moving in ways which it makes it clear that people just don't know what is going on.
yes, sir. I'm gonna have to bring Josh back on the pod sometime soon. But anyways, goodest place as ever to end it. Thanks for listening, folks. If you made it this far, Rob, have fun out in the West. We'll see you next week.